Hello, everyone. Welcome to this special edition of The Final Bar. Our mailbag has been overflowing, so we wanted to dedicate this entire episode to answering some of the great questions you guys have been sending in to us via email and on our social media accounts. Thanks so much for watching the show. I'm Dave Keller, the Chief Market Strategist here at StockCharts.com. We appreciate, as always, you watching our show every weekday after the close. Couple quick announcements before we dig into the mailbag. First off, it is a really good time to check out the StockCharts.com premium memberships. Our paid levels of usage give you some really cool opportunities to customize your charts, to save your chart list, share them with others, and also really take full advantage of our scanning engine, our alert system, all the other great tools like ACP that we show on Stock Charts TV every trading day. Go to StockCharts.com/special. You can lock in a special low rate here just for the next couple weeks. And also, if you're an existing member, it's a really good time to extend your membership. You can extend your membership now and lock in at the current very low rate. StockCharts.com/special for more information. Also, just to let you know, I will be doing a free webcast coming up next Tuesday, July 18th, called Moving Average Strategies for Investors. I often get questioned about moving averages, which ones to use, why we use certain ones, how to use them for short-term versus long-term timeframes. We're going to dig into all of those questions and also go through a bunch of examples to show you how moving averages can really help you minimize noise and maximize your returns in the markets. Go to marketmisbehavior.com/moving average to sign up for that free webcast coming up next Tuesday, July 18th. Folks, let's go right to the Final Bar mailbag again. Thank you guys so much for sending in all of your great questions. And here is question number one. Dave, there are so many technical indicators. How do I pick the best ones to use? And I'm not kidding. That is a legitimate question that I received often in many different ways, but this one in particular we received here in the last week. And that's a really good question. What I will say is this. Number one, there are a lot of different technical indicators out there. And I would say on our show, we highlight just a small portion of the technical analysis toolkit. Here's what I would tell you. There's honestly no right answer. What I share with you on the show are the charts and tools that I find most helpful. And over the 23 years I've been doing this, I've sort of refined that toolkit over time. Going through the CMT exam process, which forces you honestly to learn all the different parts of technical analysis, even things that I don't ever use anymore or rarely use. I had to learn them and had to understand the mechanics of them. And so what I would say is, as you're getting started, what I would recommend is follow some people that are finding success, follow ones that have good educational platforms, that have good trading records and are willing to share some ideas with you and take some of what they've done and use those. And I would say besides, to be honest, finding the best indicator, even the not so best indicator, but something you use consistently is going to be way more effective than the perfect indicator that you use sporadically. As I always tell people, an imperfect but consistent process is way better than a perfect but inconsistent process. So having said that, let me give you some ideas of what technical indicators you may want to use. Honestly, the default chart that I use on the StockCharts platform might be a really good place to start with because these are the indicators that I have found to be helpful. And I would say I break them into three parts. Number one, price and price-based indicators. Now, most indicators, if not all of them, are based loosely on price or volume. Those are the basic building blocks of technical analysis. But I would say particular techniques focused on price. So price itself, looking at bar and candle charts, things like trend lines and Fibonacci analysis, for me, I have found to be some of the most effective ways of just defining the trend and recognizing key levels to pay attention to. And I think that would be one bucket of things to look at. The second things I would say would be looking at trend over time, or what we call moving averages. These are ways of sort of getting rid of the noise of the markets. And especially as a longer term, medium term investor, it's really important to differentiate the short term noise, what I call the flickering ticks, versus the long-term trends and how those trends are evolving. I think that's an important thing to recognize. So looking at things like moving averages, like the 50 and 200-day moving average. Here on this chart, I'm actually using the 13-day exponential moving average as well. Things like that that'll help you just recognize shifts in trend. When a trend is in a certain phase and then all of a sudden it breaks the 50-day moving average, I think that has meaning. Finally, I would be looking at some measure of price momentum. And for me, RSI has been the way that I've used that. Now, again, when I show something like RSI, that's not to tell you that that's the only thing you could have in that area. There are other indicators like stochastics, like Williams %R, like the commodity channel index, and even different timeframes, different periods that we could look at, like a 3-day or 9-day or 30-day RSI. I'm using the 14-day RSI as sort of my go-to default. That's what Wells Wilder found as his most effective starting point. And then my bonus point at the bottom would be relative strength, looking at the relative performance, particularly if you're investing in stocks or ETFs. I'm going to insist that you look at the relative strength. That's the bottom panel on pretty much all the charts that I share, looking at stocks and ETFs, because it is so important to recognize how that particular stock or ETF is performing relative to all the other charts that you could be looking at any given time. Now, there are reasons why I found those combination of indicators. And again, as I was learning the toolkit and was working with mentors, I sort of settled in on an early form of this. And over time, I've continued to refine it. I would start there. That's my gift, is start with that as your chart and then tweak it from there. And as you learn, as you make mistakes, as you have good trades and ineffective trades, you will find what parts of your toolkit maybe need an improvement and which ones you want to hold on to. So that would be my question. And again, as you're running through different technical indicators, don't forget the chart school portion of the StockCharts platform. It's totally free and can help you understand any particular indicator if you're using it for the first time. Next question. Dave, is there a way to create a scan that shows the short interest as a percentage of float? That is such a really good question, and I wanted to bring this question on just to sort of answer the question, but also explain what it's actually getting to. So when you're saying a scan that shows the short interest as a percentage of float, if you're not familiar with some of those terms, short interest is basically a measure of how many investors are betting against a stock, right? So if you have a stock and you want to make an investment decision using the equity itself, you can either be long the stock, which means you're planning to buy low and sell high ideally, or you can short the stock, which basically means you want to sell high, wait for the price to go down, and then buy low. So it's sort of doing the same steps, just reversing them, selling first and buying it out later. What you have to do is actually borrow the shares to sell them in the open market, and then you buy them back to close out the position later. So short interest basically tells you how many or what shares are actually being shorted actively at any given time. Now those data points usually come from the exchange. If I remember right, it's twice a month. It used to be a monthly reading years ago, but now I think it's twice a month, every couple of weeks, that you get an updated short interest number. Float are basically an adaptation. If you think of shares outstanding as a standard way of measuring how many stocks are out there, how many shares of stock are available, a lot of them are actually controlled by insiders. They're not actually fluctuating or trafficking on the secondary market. So the float is basically the amount of those shares outstanding that are actually available for investors in the secondary market. So short interest as a percentage of float basically says out of the shares that are out there in the public, what percent of them are being shorted. And that's a great way of just gauging how many investors or what percent of investors are betting against a particular position. Now, the short answer, unfortunately, we don't have a way to scan for that information. What I will point you to is you can find information about that type of data on a particular name by using our symbol summary page. The way you can do that is you click on where it says Sharp Chart and switch to where it says Symbol Summary. If you're looking at one of our charts, at the bottom, you'll find these little links and you can click on Symbol Summary. That'll get you to the same place. But if you bring up a stock, you'll find all of the information like shares outstanding, percent float, which we list right here, and so much more. Our current iteration of the scanning engine does not have the ability to scan on these items. The next version of the scanning engine, I wish I could show it to you now, but it's in development for now, will allow you to do that. And the reason why I wanted to answer that question is we would love to know what other sort of items, particularly fundamental items, option-related items, any other technical indicators that you're unable to scan for. What types of things would you want to look for? Let our support desk know which things you might be wanting to scan for. We'll make sure that we incorporate as many as possible into the next version of the scanning engine once we finish that off. Thanks so much for that question, by the way. Next question, Dave, have you ever done or seen a backtest study of a technical indicator? That is a really good question at all. So the short answer is yes. The long answer is a little more complicated. So I will tell you, if you honestly use a Google search or even look at SSRN, which is a web portal to access academic research, you'll find a lot of people, a lot of academics, a lot of traders and investors that have done deep dives into different technical indicators. I will tell you that any practitioner like myself usually takes a huge issue with academic research and technical analysis because it's often taken out of context, right? They'll look at a particular indicator and declare all of technical analysis faulty or all of it as amazing because of the results of this one particular test. I have found most research that I've read like this, I can find a lot of ways to critique the methodology and critique the time frame and what sort of generalizations you're making based on that particular analysis. We don't have a backtest engine on the StockCharts platform, but I've certainly spent a lot of time testing outside of StockCharts. Even in Excel, once you get data there, you can recreate different indicators or actually bring in indicators and test them. And what I will tell you is in terms of what indicators I use, things like RSI, things like relative strength, things like price analysis, these are the things that have been tried and true. And what I would say, my experience at a money management firm, we would often say our backtest is we put money behind an idea. And things that work, we'll keep putting money behind them and we'll put them out as funds. Things that don't work, we won't use them anymore. So the things that I show you, the tools and techniques that I use on the show every day are the ones that I found to be very effective. And that's based on backtesting. That's based on, running money using those techniques. And it's based on just a lot of experience of seeing what works and what does not. I will caution you, there's a benefit to backtesting, which is you can confirm whether something worked. But what you have to remember is with any backtest, you are making some huge assumptions. And the biggest assumption is that tomorrow is going to be anything like yesterday, right? When you find something that has worked really well for a particular period, you're making an assumption that that next period is going to be a lot like that first one. A lot of times that's not a great assumption to make. So I would caution you, a perfect backtest often will not, or a perfectly backtested system often doesn't work well when you put live money behind it. And that's because maybe the model didn't take some things into consideration. Maybe the conditions change. So be nimble, be flexible, and always adapt would be my main way of answering that question. Next question, Dave, how do you determine credit spreads tightening versus widening? That is there's some really deep questions here in the mailbag, and I'm so glad we're able to take a whole show kind of digging through some of these. So credit spreads, when we talk about credit spreads, what that basically is, if you're not familiar with the fixed income markets, is it's basically looking at the spread between a corporate bond and a treasury bond, right? A treasury bond is what you consider a risk-free rate, and what that means is pretty unlikely that the U.S. government is going to default on its debt obligations. It's a possibility, like guaranteed that there's no guarantee on it, but highly unlikely. And so treasury bonds from the U.S. Treasury considered essentially risk-free. There's no risk. So the rate on that bond is sort of your starting point. Any company is a little more likely, even if it's very unlikely, even if it's a very stable company, it's a little more likely than the US government to maybe default on their debt if something crazy would happen. And then you get to really risky companies, high yield companies, or junk bond issuers, which are basically really risky companies, maybe with not a great financial history, maybe with not a great established record or great position. And as a result, they have to issue debt at much higher rates. So the spread between the corporate bonds and the treasury bonds are what we call a credit spread. And that really reflects how difficult it is or how easy it is for companies to issue debt and what sort of rate they're able to get. One of the ways I like to look at credit spreads is by looking at what we call the high yield spread. Now, this is an index series that we have on StockCharts. The ticker is a little crazy, $, HYIOAS. Sorry for the crazy ticker, but what that is basically an index that comes from Bank of America. It's a high yield index option adjusted spread. Don't worry too much about all of that. OAS, or option adjusted spread, basically means you're looking at a spread, but a lot of bonds have some different call options, basically ways that debt can mature a little earlier than the maturity date. This basically triggers all of those, so it adjusts them for any options to make sure you're looking at an apples to apples basis across a bunch of different companies. And high yield, of course, means riskier companies. So the high yield option adjusted spread basically shows you the spread for risky companies and what spread they have to use, or what spread that investors are basically demanding to buy their debt. I'm showing it inverted here so it lines up a little more with the S&P 500 chart, excuse me, at the bottom. But here you can see that spreads overall have been tightening, and that means because the number has been going down. Now, I inverted that just for comparing it. You can take the inversion off and you can see what the core values are. So the spread tightening basically means this value is basically a 4.1% premium. That's the spread above treasury bonds. When this line is going down, that means spreads are tightening. When line going up, it means it's widening. Wider spreads means a riskier environment and usually means more bearish conditions for equities. That's why I tend to plot that upside down. And thank you so much for that question on credit spreads. Next question, is this an ABC correction for UNG? We are going all over in this episode. We're going Elliott Wave. We're going to different asset classes. We're gonna hit a little bit of everything today. An ABC correction for UNG, and you were talking about it in a little bit different time frame. And actually, I think you sent a question. Yeah, you sent this chart along with you, and thanks for sending that. So this is your sharp chart looking at the UNG. That's the natural gas fund. You can look at natural gas futures, but I think the UNG is a pretty good way of sort of approximating that value in a pretty liquid instrument and one that trades essentially like an equity. What you were saying with your Elliott Wave labeling is off of the June low. This is 1, 2, 3, 4, 5. And then your question is this an A, B, C correction? And this could be a big wave 1, a big wave 2, and now we're setting up for a wave 3. So my answer would be maybe. It's hard to say whether or not that is, and I think that's one of the challenges with Elliott Wave analysis. I've often said Elliott Wave counts look really clear in the rearview mirror. When you're trying to anticipate a wave count, you can run into trouble because if this price just keeps going lower, let's say natural gas prices go down for the next 3 weeks, all of a sudden your entire wave count is wrong and you have to recalibrate the whole thing. That's one of the benefits of Elliott Wave is that it's a little more nimble than you might expect. You can actually adjust the wave counts when the market conditions dictate it. But using it for predictive value like this, you can run into trouble. So what a lot of people, what you have to remember is if you dig into Bob Prechter and Frost, their book on Elliott Wave, which is sort of the classic text on it, some of the other books, I found Steve Poser's book called Applying Elliott Wave Theory Profitably, I think. And sorry, Steve, if I butchered the title. I think that's it. I think it does a really good job of explaining some of the rules, some of the measuring techniques. And I would say if you really want to think about the predictive use of Elliott Wave, I would go through those kind of books and look at projections. So you can actually use an existing wave to project where the end of the next wave may be. I don't have time to go through that. The other thing I would say is if you're looking at this sort of wave count, I would zoom way into the chart. So on my chart of UNG, you're kind of looking at this time frame here. If that's the time frame you're looking at, I would make this a really short-term chart. And you want to really maximize this price action if you want to start dictating wave counts or identifying those. Maybe even an hourly chart. If you're looking at a 6-week period, you might want to look at like an hourly or a 15-minute chart, which is going to give you a little more dynamic information about how the price has moved over those waves and make sure that you have the right levels to pay attention to. So you may be absolutely right. And I would say that the idea that this could be a wave 1 and a wave 2, that's about right in terms of where you would be. The way you confirm that is if wave 3 really initiates and gets above the peak of wave 1. Hasn't happened yet. Great question there, and thanks for asking about some Elliott Wave. Not something we bring up on the show too often. Next question. I love this one. Thank you so much for asking this. What StockCharts feature do people not use as much as they should? I love this one, and the tough thing is, it's a tough one to answer because I would argue there's a lot of the StockCharts platform that people don't use that I would love to say. Now, I don't have hard statistics on what pages or what charts people are using. That's not something that we keep granular data on to dig into. But I will tell you one of the things we don't get enough questions on that makes me think that it's probably not being used is actually a newer functionality. It's in the ACP platform. So this is my ACP view that I use often. I want to thank Joe Rabel, who's a longtime StockCharts contributor, hosts his own show, Stock Talk with Joe Rabel on StockCharts TV. It's really well done. He uses ACP all the time, and he actually had a view with 5 charts, and I sort of borrowed that from him. I asked him first, I said, look, I want to take your view and customize it. I have a 5-chart view that I've used, not on the show too much, but this is the 3-chart view that I used after looking at watching Joe's show and trying to take some of the things that he uses on the platform. Now, at the bottom of the ACP platform, there's this little bar down here, and if you don't see it, there's this little drawer icon in the lower right. You want to click on Open Drawer. And there's a new tab that just came out on our latest release called the Sector Summary tab. And I could also point out in the upper right, you can make this a big thing, and you're basically turning your StockCharts ACP function into an Excel spreadsheet with some really cool targeted functionality. Now, the Sector Summary tab is basically taking a report off of StockCharts.com, which is our sector and industry summary reports. We have different reports to try to break down stocks and sectors and all of these different things. Now, the Sector Summary tab, basically you can sort this on scooter rankings. So I can see right now the technology sector is the top performing sector using our scooter rankings, then communication services, then consumer discretionary. I can click on technology and I can actually sort the industry groups within the technology sector by their scooter rankings. So I can see what groups are leading this group higher, leading this sector higher, which ones are struggling. If I click on software, I can then sort that list of stocks by their scooter rankings. Then what I can actually do is bring this table down, and I can actually click on the charts, and I can go through the list of charts and look at my ACP view on the names that are scoring the best based on the Scooter rankings. The fact that we actually have the ability now to have charts at one point and then bring up the different sectors and drill into sectors, into industries, then into individual names, I think is a really powerful function. That's something I was asking for quite some time, and I'm super excited that our developers were able to make that happen. So that is something I would recommend. The sector summary function within the ACP platform, really, really cool. I'd encourage you to check it out if you've not done so yet. Next question. Dave, how do you select which stocks to share on the show? And you asked, are they requests that you get from individuals that send in questions? Do you run scans to find ideas? And how do you actually do it? I really appreciate your question. I will tell you what I do every day, and I do this often. I often have this StockCharts dashboard up on my screen at all times. So in my office, I have my laptop, I have a big monitor in front of me, and then I have a smaller monitor to the right that I use for screen sharing and webcasts and video conferencing and things like that. And I usually have this page up on that third monitor at all times, because when I'm being interviewed, I'm usually bringing this up just to see what's happening. And I often refer down to these little tabs. These are the widgets that look at market movers. I always have the S&P 500 up, and I'm looking at what stocks are moving. So every day I'm sort of, during the day this updates, and I'm just seeing which names are fluctuating. And those often, the names that I share on the show, are highlighting some of the biggest movers in the S&P 500. I also look over here at the top ranked stocks just to see if there are any new names that pop up on there. It's things like Palantir and NVIDIA, or Builders First Source, names that pop up that I think, okay, maybe this is a name we want to talk about and highlight. I'm lucky that I do get a steady stream of questions, both from StockCharts TV viewers, from my own clients. My premium members of Market Misbehavior are often asking me about individual stocks, and I'll sort of keep those in mind as I'm preparing for the show as well. And then the final thing is you implied are running scans, and I'll show you the scan that I use all the time. When I go to the scanning engine, I look for stocks making new 13-week highs, stocks making new 13-week lows, and I do that on a weekly basis. And I also do that every single day. And the scan is pretty straightforward. It's basically saying, out of the large cap universe that I want to look at, which stocks have a new high, or today's close is higher than the last 65 closes. And that's a group of stocks that I'm going to look at. Stocks moving are the ones that I'm often going to want to pay attention. Between all of those things, my cup runneth over with stocks to share on the show, and that's kind of where I picked them from. Thanks for that question. Let's get to the next one. Dave, how do you use the put-call ratio in trend analysis? And you had a much larger question talking about the total put-call ratio, the equity put-call ratio. Do you use the raw data, or you use moving averages? What sort of things do you use? So that's a really good question. I'll show you on my sentiment indicator list. I'll show you what ones that I do. These are the two charts that I refer to, and the sentiment list I refer to at least once a week. I've kind of gotten away from doing it too often, but this is something that I usually do. And when I do bring up the chart, I have these horizontal lines that I use, these pink dashed lines on here. So what I'm actually doing, the gray data in the background, this is the equity put call ratio, which is $CPCE on the StockCharts platform. That's the one. The other one is the raw put call ratio, which is just $CPC. And the difference between those two, by the way, the total put call ratio includes index options. The equity only put call ratio eliminates those, and it just looks at equities. It's debatable. I think some people are really passionate about one or the other. I tend to look at both, but if I had to pick one, I would use the equity put call ratio just because it's what I've used more often. That's just what I'm familiar with, the values and where they're at. The raw data is actually super noisy. So the put call data, when I'm, as a medium-term, long-term investor, the daily put call reading is a little too much. It's kind of like looking at the daily advanced decline data. It's important to know if it was a 10-to-1 ratio of new advancers versus decliners, but I'm more concerned about the trend in that advanced decline data over time. That's why we often refer to the cumulative advanced decline lines, or things like a McClellan oscillator, which looks at them over time. So the equity put call ratio raw data is in gray. I actually have it in a gray color that's a little lighter. The trick on StockCharts to do that is use the color black or gray, and then use this setting right here, the opacity, I think you would call it, which it defaults to 1, which is actually a pretty dark line. I like to use the black color and then just dial it way down. So you're making it more and more transparent, so it kind of fades into the background. Then I take a 5-day average, and that's a pink line that's here, and I overlay that. And so that's the level that I actually look. And so what that does is basically, instead of doing a daily, very noisy reading, I'm smoothing it out by just a week, just so I have a better, less noisy, more clear data series to use. Then I just use a horizontal line. I use the annotations tool there to put a horizontal line. And what I always want to do is see where we're at relative to where we've been. So look to the left on the chart. And when I'm seeing the put-call ratio now, here in early mid-July, you can see we're at some of the lowest readings that we've been over the last 12 months, and we're back down to the levels that we were in 2021. So similar to the VIX, right, which kind of spiked in a big way in 2022, a big down year. In 2023, the VIX has actually come much lower, back down more to the levels that we've been in 2021, if not even further back to like 2016 or 2017. You're finding kind of the same things with the put-call ratio. And that's, I guess, the challenge with using put-call data is that the regime can change, similar to the VIX, right? A VIX level of 20 may be very high or very low, depending on the context, or what I call the volatility regime. I would say the put-call ratio has come down quite a bit, similar to the VIX. I think we're at pretty low levels, and so I hesitate to think of the market topping because the put-call ratio has hit a particular low level. I think that's a tough one to do. The other issue I would have with the put-call ratios now, and the reason why I'm using it a little bit less than I had before, is the 0 days to trade options, or the 0 DTT option. Those have become much more prevalent. I would argue they're very much affecting put-call data, and I think it's an open question. I don't know if we really know how much of an impact they've had. So that's why I've kind of lightened up my own use of the put-call ratio. Next question, will there be a ChartCon 2023, and will you invite attendees to be in the audience? I love that people appreciated our previous ChartCons and are excited to do it. The short answer is no. I think at this point, highly unlikely we'll be doing a ChartCon 2023. If and when we do, we will absolutely start making some noise and to get you excited about it. Years ago, we actually did a ChartCon where we had a VIP membership where we could actually come and attend in person. We have not forgotten that. I would say highly likely we do not do one in 2023. We will most likely do one in 2024. I think every other year is probably the normal pace that we're having, that we're keeping in mind. It's a lot of work, a lot of effort, but with a really good event that comes out of it. Last time for ChartCon 2022, we actually flew a bunch of presenters here to our Redmond offices. We had a really good time getting the group together, had a lot of great events kind of internally here to kind of get the contributors to know each other. We also put on a fantastic show, and we got a lot of great feedback from many of you. So I would say when we are planning the next ChartCon, things that I would probably tell you are we will probably use this studio pretty heavily. One of the great reasons why we designed this new StockCharts TV studio is to be able to do cool special events. We're still sort of finishing off now that the studio is up and running. I think we're now prepared to start planning a new ChartCon. So I would say probably not in 2023, probably definitely in 2024. But if and when we do set it up, we will absolutely make some noise and let you know. Last question, and then we've got to wrap up the show today, folks. What does the latest inflation data mean for stocks? And I'll just give you the quick answer for this one. So data this week from the economic side, we saw inflation numbers come down, right? So the CPI is the main number that comes out once a month. That's the main one that people refer to. The CPI number actually came down quite a bit, and that is the sort of monthly reading on inflation and sort of an annualized number talking about different prices. And it's different things within the cart that you're sort of normal shopping cart, things like fuel and energy prices, clothing and other things, food and other sort of perishables you may want to buy. You can actually chart the data on the StockCharts platform, and I'll show you where you can do it. I actually have a chart list called Economic Indicators, and this one's the CPI number. So $sign CPI is the seasonally adjusted CPI data. That's the raw data that you probably want to look at. I'm doing a 12-month rate of change. So I'm just using the rate of change, or ROC indicator. Put the number 12 on a monthly chart. That's going to give you the inflation number, sort of that headline number people talk about. So it's continued to come down. We peaked just over 8%, almost to 9%. We've been rolling over here over the last 12 months or so, now just above 3%. Now, this is still above the Fed's kind of target rate. What they've talked about is around 2%. So we're still a little elevated above there. And core CPI, which are sort of taking the cyclical things, but sort of those things you always need, which is a key number that Powell and other Fed governors have mentioned that they really focus on, it's still pretty elevated, right around 5+%. So what does this mean? I would say one of the quotes that I heard this week after the inflation number came out. It's too early to pop the champagne, but it's not too early to chill the bottle. I think that's a great way of describing the current inflation data. It's still above what the Fed has said, but the fact that inflation continues to come down tells you or implies that the actions that the Fed has taken by raising rates, this tightening cycle, is really starting to have an impact, and it's starting to become pretty relevant because, again, prices are still going up. That's what inflation means. That means things are getting more expensive, but at a more reasonable rate. And that's what the CPI number is trying to hit on. So I would say as long as we continue to see the CPI coming down in future months, that just means that the actions the Fed is taking starting to really have an impact for now. Inflation data turning back up, I think, would be a very negative thing for stocks. For now, you're not seeing that. You're seeing, I guess it's time to chill the bottle, as I mentioned. That was our show for today. Thank you guys so much for all those great questions. Thanks for filling our mailbag with some really thoughtful questions. Thanks for sharing charts when you do so. All of our previous interviews and a lot of other great mailbag segments and questions can be found on our YouTube channel, so make sure you check out some of our previous shows as well. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good one.